Hello everyone and welcome back to the course. And in this lesson, we will learn a little about fundamental analysis. So what do you actually mean when you say you are doing fundamental analysis of business? The question and its answer is quite simple, yet there are many who claim they can do fundamental analysis but literally have no idea what they are doing. Fundamental analysis is nothing more than checking business for its financial health. So when we say that we need business with improving fundamentals, we actually mean we need a business with improving financial health. As individual, you also have personal financial health. And three pillars of good personal financial health includes earning efficiency, spending or saving efficiency, and money or asset management. How good you are with these three skills decides either you will have money or you will end up broke. To be in good financial health, you need to be very good at any one of these skills. By being good at any two of these skills, you secure rich future for yourself. And if you are good with all three skills, then it's your destiny to become ultra rich with time. High earning efficiency usually means you have very high earning power, and low earning efficiency means you earn less. For example, assume Vicky have a very high paying job like 50k to 100k per month. With such high salary, Vicky can afford lavish lifestyle with cool cars, luxury house, expensive attires, and high-tech gadgets. Our default perception of Vicky would be he is rich and can afford lavish lifestyle. Next is spending or saving efficiency. For example, assume Jackie have regular paying job, but Jackie is extremely good when it comes to making good spending decisions, and she always manages to save good amount of money from her earnings. What will happen is that over years, Jackie will build herself pile of money from her small but regular savings. Our default perception about Jackie would be she is regular person with ordinary job and earnings. And that default perception is not going to change until she does something to reveal that she has now accumulated massive amount of wealth. Let's assume she buys herself $1 million house. Then our perception towards her will change. Final thing is money or asset management. For example, assume Chen have a low paying job, but Chen have very high level understanding of assets, liabilities and their interconversion. Keep in mind, anything can be classified as asset only if either its value appreciates with time or it keeps paying regularly. So what Chen does is, from his small earnings, he keeps buying several assets that may start paying as soon as he purchases them or might appreciate a lot in price in near or distant future. Our general perception of Chen would be, he is poor and that perception is not going to change for time. His assets will start generating regular cash for him. After 10 years, Vicky, Jackie and Chen all are rich because of their respective efficiencies in their financial skills. Now comes the important question. If you were to analyze financial health of Vicky, Jackie and Chen, would you be doing it in similar way? The answer is no. We will analyze their financial health based on their respective financial efficiencies. Same also applies to businesses because businesses also operate on same financial efficiencies. A business with high earnings needs to be analyzed based on its profit after tax, profit margins, return on equity, earnings growth rate, or we can say only those things which can provide evidence of high earning efficiencies. A business with high saving and spending efficiency needs to be analyzed with help of its good cash flow, net worth, capital expenditure, or we can say by those things which can provide evidence of high spending efficiency. Similarly, a business with high level of money or asset management skills needs to be analyzed with help of its debt to equity, return on asset, net sales, quality of assets, or we can say by those things which can provide evidence of high-level asset management skills. A business can have only 1, 2 or all 3 financial efficiencies. While fundamental analysis, we select the numbers and ratios that needs to be checked based on what kind of financial efficiencies we want our stocks to exhibit. In this course, we are focusing exclusively on businesses that are at present exhibiting high-level earning efficiency. Keep in mind, we are doing reactive analysis, and our investments will be reaction to current improving earning efficiency of business. Keep in mind, we are working on earning efficiency just because it is kind of financial efficiency that is easiest to understand. Even with primary education, you can easily tell 10 is bigger than 5, and that is all information you need to understand earning efficiency. Saving and asset management are skills that majority of us fail to understand. For example, most people struggle with even basic level saving efficiencies, like not able to decide what kind of saving plan should I select or what kind of life cover should I take. And when it comes to asset management, almost 95% people of world end up accumulating liabilities on name of assets without even noticing. When your personal level savings and asset management skills are so bad, can you expect to really understand how good a business is when it comes to spending efficiency and asset management? Do not live with idea that earning efficiency is best kind of financial efficiency to invest on. Businesses with all three kind of efficiencies have their own advantages and disadvantages. By focusing on businesses with earning efficiencies, we reduce our time to see profits to 1 to 2 years, but it also comes with drawback that profits made on them are smaller. Don't worry, those small profits are still 100 to 100% or even more. Businesses with high spending efficiencies may take years to generate upside, but upside happens all of a sudden with 10x, 20x or even more profits. Ashish Chugh and Vijay Kedia are some investors which invest on high spending and saving efficiency of business. Businesses with high level money and asset management skills usually end up becoming very big over time. These are businesses that are likely to become dividend paying stocks of future. Problem with these kind of businesses is that they may grow very slowly. On positive note, you can buy their stocks in every market crash and eventually they always bounce back, thus keeping you in overall profit along with dividends. Businesses which can exhibit all three financial efficiencies become as big as Reliance, MRF, Apple, Coca-Cola or Amazon with time. While investing, we are focusing only on one financial efficiency because it will make our investing method easy to understand and implement. The more financial efficiencies we will demand, the more complicated investing method will become. As your instructor, my job is not to overload and overwhelm you with information. My job is to provide you investing method you can implement right away. So for this course, we will just stick with earning efficiencies. Just look for the 3 earning scenarios that were discussed in last lesson. They will help you pick up businesses with high earning efficiencies. Your final question might be, if we are to focus on earning efficiencies, why aren't we calculating earning growth, return on equity, or expansion in profit margins? To that, answer is it is not required. It's obvious that with increasing quarterly earnings, they are going to happen. Think like this. If in year 2017 your monthly salary was 10,000 and in year 2018 your monthly salary is 15,000, will you really need a calculator to tell that in financial year of 2018 you have earned more than 2017? It is obvious. Ratios to great extent are important when you are scanning for stocks completely based on fundamentals. Our scanning method is technical, which grants us privilege to avoid ratios in our analysis process. In next section, we will take a look on how to make buying decisions on stocks once they match our required fundamentals. With that said, thanks for watching this lesson and see you in next lesson.